Same thing as deciding to build a factory. The company decides to invest money in the factory now in anticipation of the factory producing products that'll be worth a certain amount of money later. The company can use the beginning value and the ending value to calculate the rate of return on the factory. Do you have a mortgage on your house? That's another example of the concepts we're using. The mortgage lender loans you enough money up front to let you buy the house in exchange for a series of payments over 15 or 30 years. The size of those payments depends on the interest rate you pay. One day, a former student called me with a question. His parents had bought him a lottery ticket as a gift, and lightning struck. He'd won what the State Lottery Commission called $1 million. He didn't get the $1 million right away, though. He was actually going to get $50,000 a year for 20 years. He wanted to start a business now, and he was thinking about trading some of those future payments for cash now. A financial firm had offered him about $145,000 now if he promised to give them the 4 $50,000 payments he would get in years 2, 3, 4, 5. We were able to calculate the interest rate the company was charging him for the loan. It turned out to be a bit more than 9.5%. Do you own life insurance? When your insurance company calculated your insurance premium, it used the same time value of money ideas that we've been using. If you want to buy a policy that will pay your heirs $500,000 at the time of your death, the company has to figure out how much to charge you for that protection. The premium can't be too low or the insurance company will lose money on the deal. Can't be too high either because they'll lose your business. You'll buy a policy from some other company. The company takes its best guess of your lifespan, sets the rate of return it needs to be competitive in the marketplace, and calculates the size of the premium that produces that rate of return. Have you ever leased a car? You've probably noticed how the cost per month usually ends in 99. Maybe it's $199 or $299 per month. Advertisers want that first number to be as small as possible. $199 somehow sounds lots cheaper than $200. That's a pretty standard marketing technique. What's not standard is the amount due at signing. I've seen ads that say $4,816 due at signing. How did they come up with a number like that? Wouldn't you think they'd try to get it to end in 99 too? Well, sure they would, but the financial numbers usually don't work out that way. If we strip out extras like the cost of maintenance and insurance, then we can see that a 3-year lease is a lot like an agreement to sell you the car today and buy it back in 3 years for a predetermined price. The company leasing the car to you knows what the car's worth today, it knows about how much the car will be worth in 3 years, and it knows the size of the monthly payments, say $199. It can take those numbers along with the required rate of return it needs to make money on the deal to figure out how much has to be due at signing. Now you know something about the 3 things that determine your investment success: how much you invest, how much you earn, and how long you invest. Next, we'll take a closer look at why, no matter what you see and hear from investment advisors, it's almost impossible to find investments that promise high returns with little risk. Some people see that as the glass being half empty. I prefer to see it as being half full. Unless we make a big mistake, then we can be confident that we'll do just about as well as most everyone else.